we've got the management of Bank of Baroda joining us on the show now. We've got Mr. M.D. Mallya, who's Chairman and Managing Director of the bank. Mr. Mallya, the first big concern really for every viewer is that the Bank of Baroda stock is down 10.2% in the month of May. It's been the worst performing banking stock. How would you placate investors?
If you look at the results which we have recently published, I think the bank has been able to do quite very well despite very challenging conditions. A growth of around 23% in the operating profit, a growth of around 18% in the net profit, I think in the current circumstances is exemplary. Secondly, the increase in the profitability has come on account of a sustained increase as far as the net interest income is concerned, a growth of around 17% over the last year. The fee-based income has also shown a growth of 22%. If you look at the recovery performance, I think the recovery performance has been amongst the best. What we have done in the past, I think we have bettered it. A overall recovery of around 909 crores during the year 2011-12. Therefore, any parameter, if you look at it, I think the bank has been able to do well. The return on asset has been 1.24% for the current year, which is quite significant. The net interest margins have been retained at about 3.51% for domestic business, which again in the current circumstances last year prevailing, where the interest rate scenario was ruling quite very high, I think is a commendable achievement. I think therefore you look at any of the parameters, yeah.
Go ahead.
Yeah, I was only telling that look at any of the efficiency parameters, the bank has been able to do quite very well. A cost to income ratio of only about 41%.
Mr. Mallya, but another concern also is your asset quality. The gross NPAs have grown at 42% on a yearly basis and at 15% on a quarterly basis. Do you see this trend continuing?
See, we had given a guidance at the beginning of the year that our delinquency ratio will be in the range of around 1.3%. We are slightly above that at about 1.4. But then the point which needs to be considered is that we have been able to absorb the provision requirements as far as these incremental impaired assets are concerned. We have continued to maintain a provision coverage ratio of above 80%, and our gross NPL at March 12th was only at 1.53% and the net NPL is at only about 0.53%. I think by any stretch of imagination and in the given scenario, I think the bank has been able to protect its asset quality and do quite significantly well.
Right, but Mr. Mallya, what's the outlook on the margin picture? Do you expect that margins will come under pressure over the next few quarters, or do you believe, or are you confident that you can maintain margins at current levels?
See, the margins were impacted last year for a couple of reasons. Predominantly the consumer preference to keep the surpluses in the time deposits rather than on the SB. I think that has been a general phenomena which we have seen, and it is natural in the background of the higher interest rate scenario prevailing. But going forward, I don't think that those pressures will continue in the current year. One would have to try to see that the overall ALCO management is done in such a way that the increase in the cost of deposit is monitored well and moderated. As far as we are concerned, the net interest margin of around 3.51% for the last year was a good achievement, in line or perhaps slightly above what we had expected or guided. So going forward, I would say that the impact cannot be more than about 5-6 basis points either way, because we still have a very strong base of CASA, which have been above 33.3% right along. We have been consistently maintaining that. The CASA growth has been reasonably good, even in difficult conditions, and the reliance on bulk deposits in Bank of Baroda has been significantly less vis-a-vis the industry. So therefore, the overall emphasis and focus will continue to be on the liability management, garnering resources at reasonable cost, and try to say that they are deployed at reasonably good yields. I think therefore overall margin guidance for the next year will be maybe in the range of around 3.4-3.45% on the domestic business.